Closing the books is a sequence of 10 steps, run by accounting, performed by 10 different functions across 8 business days. This video walks all 10 in order: who does each one, who checks it, and why you can't do them in a different order. All 10 exist because a company spent a month recording things: shipments, invoices, payments, payroll, and now has to turn all of it into one set of numbers somebody signs their name to. We'll follow one real close at the company this channel follows throughout: Redline Performance Group, a brake and suspension manufacturer in Knoxville, Tennessee. The month is November 2025. November 30th is a Sunday, so the last transaction that counts happens at 11:59 that night. Business day 1 is Monday the 1st. Books close on day 5. The package publishes on day 8. Business days, not calendar days. Day 6 is Monday the 8th, not Saturday. And the order isn't a preference. You can't reconcile the bank until the cash is posted. You can't work out what's missing until you know what arrived. You can't explain why a number moved until it stopped moving. Every step feeds the next. That's the whole reason there's a sequence at all. Step 1. Cutoff. This is the accounting system's period screen. November is open. Anything posted today still lands in November. Thomas Dewey, the controller, closes it. Nothing else can be recorded into November now. Not by sales, not by the plant, not by accounting. Reviewed by Marcus Chen, the CFO. Day 1, 6 minutes past 8. Every step after this one assumes that line held. If it didn't, nothing downstream is true, and you won't find out for 4 days. Step 2. The subledgers. A subledger is a specialized ledger feeding the main one: payables, receivables, payroll, inventory, cash. Redline runs 12. Watch what happens when you sort them by owner. They don't close one after another. They close at once, on day 1, run by 7 different functions. Add the controller on Cutoff, and that's 8 parts of the company live before lunch. That's what a parallel close means. Not that accounting works faster, that the work was divided before day 1 arrived. All 12 closed by 4:48 that afternoon, reviewed by the controller, not by the people who closed them. Step 3. Day 2. Bank reconciliations. The statement imports straight from the bank, and the system matches most of it automatically. 943 of 984. S. Chen works the 41 it couldn't. What's left is timing. Deposits that haven't cleared, checks that haven't been cashed. Those never automate away. And notice who signs it off. D. Park, Corporate Accounting, not the person who prepared it. Hold on to that. Step 4. Day 3. Accruals. An accrual is a cost incurred in November but not yet billed. A utility bill that didn't arrive in time. The lawyer who hasn't invoiced. The bonus earned and not paid. Record only what you were billed, and November looks cheaper than it was. Here's the part that makes an estimate safe, and it's one checkbox. Before posting, the accountant marks the entry reversing and sets a date: December 1st, the first day of the next period. On December 1st, the entry reverses itself. What was debited is credited, what was credited is debited, and November's estimate vanishes out of December. Then the real invoice lands: $153,240. What's left sitting in December is the gap between the guess and the bill: $4,640. The estimate corrects itself, and nobody had to remember to correct it. Step 5, Day 4, Account Reconciliations. Proving each subledger still agrees with the general ledger, account by account. Receivables were $36 million, the highest in company history. Not every difference gets an entry. Redline's posting threshold is $25,000. Below that, you log it and explain it. Above it, you book it. And this is the one thing in November that didn't land on time. 2 distributors were paying slowly. More invoices, more cash to apply, more to reconcile. It landed the morning of day 5 instead of the afternoon of day 4. 1 day. Nobody did anything wrong. There was simply more of it. A volume problem, not a discipline problem. One you fix with people, the other with habits. Step 6, also day 4. To the outside world, Redline is one company. Legally, it's two, the parent in Knoxville and a plant in Ontario, California. Ontario builds specialty parts and ships them to Knoxville, which sells them on. Both entities record it. Ontario books a sale, Knoxville a purchase. Add the two entities together, and November revenue reads $19.8 million. But Redline didn't sell that to anyone outside itself. $1.4 million was Ontario selling to Knoxville, the same product counted twice. Take it out, and you get the true number, $18.4 million. Two more come out the same way. Skip any of it, and revenue is overstated, while every line underneath still adds up perfectly. That's why this step exists. The books can balance and still be wrong. Day 5, and 3 things happen. Step 7, the trial balance. Every account, debits equal to credits. Proof the bookkeeping holds together before anyone tries to read it. Step 8, the flux. Nigel Osei in Financial Planning and Analysis takes every line that moved and writes why. Not whether, why. And notice who does not write it. The accountants who produce the numbers. Osei sits in FP&A, which reports to the CFO. Step 9, the statements themselves. Revenue, $18.4 million. Net income, $1.4 million. Total assets, $178 million. Books closed. Business day 5, on target. Step 10, day 6. Closed and reported aren't the same act. The numbers now become a package somebody outside accounting can read. Day 7, the board package. Day 8, it publishes to the sponsor, the board, and the bank. And that date isn't a courtesy. The credit agreement requires it inside 10 business days. Day 8 leaves 2 days of room. A close that runs long walks toward a covenant. So back to the promise. Why can't you reorder them? Because every step is somebody else's input. Post the cash before you reconcile it. Know what arrived before you estimate what's missing. Finish the number before you explain it. Move one and the step after it is working from something unfinished. And look at the ownership. 12 rows, and every one of them has 2 names on it. One person who did the work, one who checked it. Never the same name twice on a row. Next, a close can finish on time, tie to the penny, and still be wrong.